Hi, I'm Monk and this is the Monk Way. Let's look at an easy way to really profit from earnings reports. We'll look at all the key factors when it comes to earnings, and then see how we can profit from them in a very safe way. This is one of the best ways to swing trade in the market. Subscribe and hit that bell for more stock market videos like these. I make them every day to make you smarter, and leave a like if you want more videos like this. Let's begin with a simple explanation of an earnings report. These reports are numbers released by the companies you're interested in. They release these reports every 3 months, dividing the year into quarters. Investors like to use these numbers to see how well a company is performing in the short term. You'll see terms like earnings report for the quarter up until March 2018, meaning all 3 months from January, February, and March. If a company releases good numbers, meaning their sales and profits are doing well, the stock usually goes up afterwards. This means we can take advantage by buying a good stock that just released a good report. These reports come out after the market is closed, so usually you can't get in on the spike unless you buy before the report comes out. Buying before a report is very risky because no one knows if it's going to be good news. People who analyze stocks will have an idea of what numbers will be coming. These estimates are based on what the company thinks the next quarter will bring, and what analysts think as well. This is how we get beats or misses when talking about earnings. When a company beats the numbers the analysts are expecting, this is a good sign. If a company comes in at lower numbers, like lower profits, this is a bad sign and usually reduces the stock price. Now let's look at the 4 main numbers to look for. The most important number starts with the revenue. This is cash the company made in those 3 months, not counting any costs to make that money. For example, if Apple sold one iPhone last quarter for $1,000, their revenue would be $1,000 for that quarter. Revenue is pure money before any other numbers like costs of making that iPhone comes in. A company can't have profits without revenue coming in, so this is a very important number to see how well a company is doing. Using Apple's real earnings report in July as an example, for the months of May, June and July, they made $53.3 billion. Analysts were expecting $52.3 billion, so they beat this number, a good sign. You'll want to see a number that beats the estimates by a good amount. A 10% beat would be amazing. Next we have the EPS, or earnings per share. Earnings just means the profit a company made, so if Apple sold one iPhone last quarter for $1,000, and it costed them $300 for the parts of that phone, and $200 for labor and advertising, then they earned $500 profit for the quarter. Earnings are money they get to keep, because there are usually costs to do business. A very important number since higher profits mean the company grow faster. If a company is making billions in revenue but it costs them more than that, then the business might fail even though they're making good revenue. And since we're looking at the earnings per one share, we divide the company's total profits, let's say $500, by how many shares of stocks they have. If Apple had 10 shares in total, 500 divided by 10 is an earnings per share of $5 per share. In real life Apple has over 5 billion shares and billions of profits, but the calculation is the same. Using their real earnings again, we see an EPS of $2.34, which doesn't seem like much profit, but that's per one share. 2.34 times 5 billion shares is $11.7 billion of profit for 3 months. This number still doesn't mean anything unless we compare it to what analysts expected. They were expecting only $2.18 per share, so Apple beat this number by 7%, a good sign. Those are the 2 most important numbers. Then we have something that's different for each stock. Investors really care about the biggest money maker of a company. For Apple this is iPhone sales, so this is a number unique to Apple. For other companies like Activision Blizzard, it might be video game sales, or computer chip sales for Intel, and number of new cars being made for Tesla. Usually it relates to the popular product. Apple's third most important number is iPhone sales, because it makes up for a huge chunk of the company's revenue. They sold 41.3 million last quarter, but analysts were expecting 41.8, meaning they missed this number. They didn't sell more iPhones than last year. The good news is, they increased the average price of an iPhone sale to $724 because of new iPhone X prices. Even though investors might not like the lack of iPhone sales, the increase in profits might make this good news. The last important thing to look for is guidance. This means what the company think they'll make next quarter. For Apple, they expect 60 to 62 billion next quarter, beating analyst expectations of 59.5 billion. You want this number to be as high as possible to make investors optimistic. Sometimes a company can beat all numbers but come out with a low guidance, causing investors to sell the stock. This means all 4 numbers of an earnings report are important. If even one misses, that's enough reason for many to sell. Now we'll look at how Apple did after this good report. Here's their 1-month chart. They reported right here on July 31st. In 1 day they went up 5.9%, 9% in 2 days, and it's up 10% so far. It's very likely they spiked up around 5% right after the report, meaning the average investor can't get in that early, since the report comes out after hours, and computers automatically buy on a good report instantly. But we could have bought right here and be up 4% so far. This is why earnings reports are very safe ways to swing trade stocks. It's as easy as reading those important numbers, see how the market reacted, then buy in on a good reaction. You'll want to wait at least half a day to see how the market is reacting, because sometimes a small detail drops a stock. This can happen later in the same day even if a stock spiked up after hours. Let's look at Apple stock for the whole year. Here's the recent spike from an all-positive report, except iPhone sales. The one before this was in May 1st, with a 12% spike in less than 10 days. If I was playing this report, I'll scan the important numbers. EPS was $2.73 versus $2.67, a beat. Revenue was $61.1 billion versus $60.82 billion, a beat. iPhone sales were 52.2 million versus 52.54 million, a small miss. And for the next quarter they expected 51.5 billion to 53.5 billion versus 51.6 from analysts, a beat. Then I'd wait for how the markets reacted. If it went up 5% after hours, it's a sign to buy in. In the report before this one, they also beat numbers, but iPhone sales were 77.3 million versus 80 million expected. This caused a 7% dip because of panic selling. The market corrected this and it rised up 8% shortly after. We can see in the short term, it's still volatile, but a stock usually goes up over time after good numbers are reported. Let's look at a few more examples of good and bad earnings reports. Walmart just spiked up 10% in one day thanks to their latest earnings report. A quick look at the numbers. EPS of $1.29 beating $1.22, revenue of $128 billion beating $125 billion. And the third important number was in-store sales, which increased 4.5% versus 2.4% expected, a huge beat. They also have another important number in online sales, which was up 40%, and the guidance for the whole year was up to $4.90 to $5.05, EPS beating $4.75 to $5 expected before. This was a beat on every single number, and on top of that, Walmart was already on a dip, giving them this high spike even on a blue-chip company. In the stock market, prices tend to account for future growth. This means a stock's current price might take into account its possible growth for the upcoming months to years. So if a company doesn't beat every number as expected, even a good earnings report can drop a stock without it being amazing. NVIDIA just reported earnings and they dropped 5% after hours. Let's see what the problem was. We start with the EPS of $1.76, which beat $1.66 expected. So far so good. Revenue of $3.12 billion, beating expectations by a bit of $3.1 billion. This was a huge 40% year-over-year growth. The third important number were all the chip sales in gaming, computers, and data centers, which were all beats since revenue was up. And the problem was future expectations, the fourth important number. They expect $3.19 billion to $3.32 billion, lower than analysts at $3.34 billion. This was because crypto mining cards are not being sold as well, due to Bitcoin being worth less recently. People were expecting NVIDIA to really profit from this crypto craze, which was priced into NVIDIA's stock. When news of lower crypto mining sales are announced like this, investors will take it as a bad sign even if they beat all numbers. This is not to say that it'll keep dropping, it might still be a good dip to buy because they beat all numbers. Let's look at another stock that went down 20% after earnings, Netflix. They missed revenue, beat earnings, but what people didn't like was weaker subscriber growth. This is a company that really needs subscribers to pump up their revenue. So when they announced 670,000 American subscribers versus 1.23 million expected, investors really sold this fast. This example also shows that low-value, volatile growth stocks are more prone to high drops during bad earnings, meaning a slow and steady company like Coca-Cola might dip 4% on bad news, while Amazon and Netflix might dip 10% or higher in a day. This also shows it's extremely risky to buy a company before an earnings report. We saw Netflix and Facebook take a 20% drop in less than a week after earnings. If you invested $100,000, you would be down $20,000 in a day or so. The less risky thing to do is riding an uptrend when earnings is all good news. Here's AMD after a great earnings report, from $10 all the way up to $19, a 90% increase. During the first earnings day, it went up 10%, even buying it after that would net you almost 80% over the months. This is why buying after earnings can also make you good money. If you ride the good hype around a company you know and understand, make sure all four numbers look good, and hold the stock for at least the next 2 to 4 weeks, then you will likely get some quick gains that beats the market as a whole. A simple site I use to track earnings dates is stocktwits.com. Their earnings calendar tell you of all the upcoming earnings for the future. It's as simple as looking at the current day and week, see if any interesting companies are reporting. It'll tell you if a company is reporting before bell or after bell. Before means in the hours before the market opens, and after means after it closes. Before hours is better since you only have to wait a few hours to buy, while after means waiting the whole night and morning. Here we have NVIDIA and Walmart reporting the same day, and it shows you the stock movement as well. This is the type of safe investing I make every week in my stock market group. In Monk's Market Moves, I show you my every single trade, updated live on email to you guys. It includes my real stock portfolio with over $240,000. If you were in my group just 2 weeks ago, you would have seen me buy $22,000 of Canopy Growth. It went up over 25% in one day, giving me this $5,600 profit. These are all real profits I've taken just in recent months. Tesla for 10%, PayPal 8.9%, Adobe 7%, AMD 37%, Facebook 6%, and more. Look in the description for a 50% off coupon. I want to make sure everyone gets in before its full price very soon. Subscribe and hit that bell for more stock market strategies. I make these videos every day to keep you informed, and leave a like if you learned a new tip today. Keep watching to buy stocks on good reports, the Monk way.